welcome to the channel JAIIB and CAIIB Made Simple. So this is our IE&IFS unit number 36 theory portion, and the chapter name is the derivative market. So before going into the chapter, let's see what are the topic which we have to study. We will see the introduction, we will see what is derivative, what is the history of derivative, and what is the size of the derivative market, what are underlying asset, what are exchange traded and over the counter market, who are the participants in the derivative market. So these 7 topics we will try to cover in this particular session, and the rest 7 topics we will cover in the next session. So this entire chapter we will cover in 2 sessions. So let's get started with the introduction of the derivative. Imagine you have a tool that let you guess or protect yourself from changes in the price of things like milk, good, or even money from another country. That is what derivative are. So this is the kind of special financial agreement whose value depends on something else. So just now I'm talking about derivative. So suppose you have a tool that let you guess or protect yourself from changes in the price of things like milk, gold, or even money from another country. So it protects you from changes in the price of things, right? So derivative you can call, they are a special financial agreement. This is a kind of a special financial agreement, right, whose value depends on something else, whose value depends on the underlying asset, right? And the underlying asset could be any kind of product. It can be oil, it can be gold, right? It can be financial things like a stock, it can be currencies, it can be interest rate, or it can be market indexes, right? So the underlying asset can be of any type. So just now I told you that derivative is a special financial agreement whose value depends on the underlying asset. Now derivative are mainly used for 2 big reasons. What are the 2 big reasons? The first is to hedge. The first reason is to hedge. Hedge means to protect yourself from price change that might cause loss. To protect yourself from price change, that is called hedging. And the second second reason for using derivative is the speculation, which means to try to earn money by guessing how price will go up and down, how price will go up or how price will go down. So that is called a speculation, to try to earn money by guessing how price will go up or how price will go down. So derivative, they are mainly used for 2 reasons. First of all, hedging, which means to protect from the price change. And second reason is a speculation, which means to try to earn money by guessing how price will go up and how price will go down. Now derivative comes in 2 main places. So what are the 2 main places where derivative comes in? Either it is over the counter. Over the counter we call OTC. OTC means privately agreed contract between parties. So when I say OTC, it simply means privately agreed contract. Privately agreed contract between the party is called OTC. And derivative can be exchange traded. What is the meaning of exchange traded? So let me tell you the meaning of exchange traded. It means contract bought and sold openly on an organized market. So there is a market that is called organized market. So in the organized market, what happened? Contract bought and sold openly. Now the most common type of derivative includes forward. What is forward? Forward is the agreement to buy or sell something at a fixed price on a future date. Second is future. Future is like it is just like a forward but traded on exchange with a standardized term. So that is called future. Option are the contract that give the holder the right but not the obligation to buy or sell the asset at the set price before a certain date. And finally we have the swap. Swap are a kind of deals where 2 party, right, where in the case these are the kind of deals where 2 party exchange financial benefit. 2 party exchange financial benefit. This is called swap. So forward, future, option, swap, these are the most common type of derivative. An example to understand derivative is butter price depending on the price of the milk. So let me give you one example to make it more clear, like butter price. So butter price, it depends on the price of the milk, right? Butter itself has no independent value. It depends on the milk price. Similarly, the value of the derivative depends on the value of the underlying asset. Legally in India, right, derivative are considered securities that come from other financial instrument like share, right? So legally, as you can see, derivative are considered security whose value is derived from the another financial instrument like share, debt, loan, contract for differences. So financial derivative includes what? Financial derivative includes forward, future, options and swaps. And what are the things under commodity derivative? So commodity derivative involve futures, options, right, on metals, agriculture, bullion, crude oil and more. So basically this overview focuses mainly on financial derivative, tools that help business and investor manage risk. So let's recapitulate the key point which we have covered in the first slide. So I told you that derivative are the contract whose value depends on an underlying asset. Underlying asset can be commodity, stock and currency. So second point, I told you that derivative help in hedging risk and or speculation on the price change. Third point, I told you that they can be traded over the counter or they can be exchange traded. So OTC means privately agreed contract, and exchange traded standardized contract. Then common types of derivative includes forward, future, option and swap. Now I told you the value of derivative has no standalone value. They come entirely from the underlying asset. One example I give you, like butter price is a derivative of the milk price. Then under Indian law I told you that derivative are defined as security derived from instrument like share or loan. So these are the point which we have just cleared. Now friends, let's look at the history of the derivative. Yes, let's go through the history of the derivative. So derivative is not new. They have actually been around for thousands of years, even before money existed. So people used to trade goods that would not spoil quickly to keep value and trade in the future. One of the earliest record come from the ancient Sumer, right? As you can see, Sumerian innovation. So ancient record come from the one of the earliest record come from the Sumer around 4500 to 4000 BC. So the Sumerian created a system of writing on clay tables, clay tablets and tokens that recorded delivery dates for good. So what they did, they used clay tokens and tablet to record delivery date. This was quite like early version of the future contract, where you agree today to buy or sell something later. Then comes, around 600 BC in ancient Greece, a man named Thales of Miletus. So the man name was Thales of Miletus. They made agreement called call option. So what he did, he paid a small amount upfront to have the right to use olive oil prices later, betting the price would go up. When it did, made a profit just like modern option contract. So Sumerian innovation and first recorded derivative was in the ancient Greece. Then comes, fast forward to 1515 in Antwerp, Europe, the Bourse, which means early stock exchange. What is the meaning of Bourse? This is the early stock exchange. Right. They started to see trader using forward contract. That means instead of actually trading the goods right away, people agreed on contract to trade them later at the set price. In the 18th century, Japan created one of the world's first true future market that is called Dojima Rice Exchange. Yes, Japan created world first stock exchange, first future market that is called Dojima Rice Exchange. So what they did, they introduced transferable rice voucher and a clearinghouse which help people trade rice for future delivery safely. So Dojima Rice Exchange, what they did, they introduced transferable rice voucher, right, and a clearinghouse. So two things they introduced, transferable rice voucher and clearinghouse, right. So which help people trade rice for future delivery safely. Then in the year 1848, the Chicago Board of Trade began trading future contract in the United States. This market grew quickly and included products like corn, wheat and metals. Then we have, if we talk into the Indian context, in India, the history goes back to 1875 when the Bombay Cotton Trade Association. So this Bombay Cotton Trade Association, they started future trading. What they did, they started the future trading. But later, the government banned this market, pushing them underground until rule become more relaxed. Between 1995 to 2001, India took important step to officially allow derivative trading. Yes, important step were taken by India to officially allow derivative trading. So the security law, securities law, that is the amendment, Security Law Ordinance 1995. They helped lay the legal groundwork. By 2000-2001, India's regulator like SEBI permitted trading of derivative on major stock exchange like NSE and BSE. Yes. So SEBI approved derivative trading on NSE National Stock Exchange and BSE Bombay Stock Exchange, marking the start of the modern formal derivative market in India. So friends, let me summarize what we have covered. Let's recapitulate. So friends, we talked about the early form of derivative existed even before money, using goods that did not spoil easily. Then we talked about the Sumerian innovation. So Sumerian created record keeping on clay tablet, early version of the future. Then we discussed, Thales of Miletus. In the 600 BC, they used call option like agreement on olive oil prices. Then we discussed, medieval exchanges. So anti-verb boards saw forward contract emerge, focusing on contract rather than immediate trade. Japan Dojima Rice Exchange. So basically what they did, they started the first real future market with rice voucher. Then Chicago Board of Trade in the year 1848. They expanded the future trading in the US for farm product and metal. And India began future trading in the year 1875, but government ban led to informal market until liberalization. In 1995 to 2001, India legalized and formalized derivative trading with SEBI's approval on NSE and BSE. Now friends, let's talk about the size of the derivative market. So friends, derivative market is a huge and very active. People often trade contract worth many times more than the actual value of the thing they are based on. This is called, being highly leveraged. You see this word written highly leveraged. It simply means, when I say highly leveraged, it means, people often trade contract worth many times more than the actual value of the thing they are based on. See, two things are there. Or suppose things are there, right? So for things, there are some actual value. For say derivative is highly leveraged, it simply means that people often trade contract worth many times more than the actual value of the thing they are based on. Imagine borrowing money to buy more contract than you could afford otherwise. That is how the market grew big. It means you could afford very small, but you are borrowing money, right, to buy more contract. That is called high leverage. That means people often trade contract worth many times more than the actual value of the thing they are based on. That's why it is called highly leveraged. Now in India, Security and Exchange Board of India, that is called SEBI, right? So basically SEBI first allowed trading of index future. So what is the meaning of index future, So basically these are the contract which are based on market indexes like S&P, CNX, Nifty, Sensex. Soon after, option means the right to buy or sell on these indexes and on individual company stock were also allowed. So option on indices and individual securities were later permitted. Then, so basically if you look at the quick timeline for India, on June 4, 2001, trading of option on BSE Sensex started. In July 2001, options on individual company stock begin. In November 2001, future contract on individual stock were launched. And National Stock Exchange began derivative trading with Nifty Index future on June 12, 2000. So globally, derivative includes even bigger number. As you can see, exchange traded future contract were valued across 34 trillion US dollar. Exchange traded option were valued at about 53 trillion dollar. Over the counter, so this is how much $610 trillion. OTC interest rate is about $466 trillion, right? So these are the data that has been given. So in India, as of the late 2021, the outstanding derivative contract are you can see 1,65,76,456 lakh INR, and foreign currency derivative are 46,42,939 lakh, and interest rate future. That's just a figure. You need not remember it. Just these are the figure. So basically now the question is, what are these derivative based on? So the derivative are based on the underlying asset. The underlying asset is the key. They are based on the underlying asset. Now the derivative value come directly from this kind of asset. What are the asset which are included under it? Like commodities like grains, coffee, pulses, right? Basically everyday agriculture product. You can call them everyday agriculture product. Then precious metals like gold and silver, right? They are also included under the underlying asset. The third kind of asset we have is the natural resources like oil and gases. These are also included. Then foreign currency, foreign exchange rate or currencies, right, between the different countries' money. So they are also included. If we talk in terms of bond, so what are the bonds? Bonds are basically the loan which are given to the government or the companies by the investor. Suppose you are an investor, you are giving loan to the government or you are giving loan to the company, right? So that is called the bond. So bond can also be underlying asset. Share, you know, stock, right? And share warrant traded on recognized stock exchange, right? They are also the part of this. Then we have, you know, stock indexes, you know, which represent a group of stock, right? A stock group we can call it, like, you know, Sensex or Nifty. Then short-term securities, short-term government security, which we call treasury bill. Then over-the-counter market, money market product, like, you know, loan, deposit, etc. For example, if you have a derivative contract based on gold price, suppose you have a derivative contract based on gold price, its value will rise, its value will fall as the gold price changes. So gold is the underlying asset here. So let's recapitulate the key point which we have covered in these two slides. I told you that, you know, the derivative market is very large. It is highly leveraged. I told you, it is vast and highly leveraged, right? Sometimes much bigger than the value of the underlying asset. Second point, I told you that SEBI allow index future and option trading in India. Right, index future and option trading in India were allowed by SEBI starting from the year 2000, right, with more product like stock option and future added in 2001. Then I told you that globally derivative market involved trillions of dollars across future, option, foreign exchange and interest rate contract. I told you that India's derivative market include equity, foreign currency, interest rate derivative worth very large sum. And what are the things under underlying asset? I told you, like commodities, precious metals, natural resource, foreign exchange, bond, share, treasury bill, money market product, etc. Now friends, let's switch our focus to the next topic, that is the exchange traded product and the over the counter market. So when people trade derivative, they can do it in two main places, an organized exchange or directly with each other in private deal, which is known as the over the counter or OTC trading. So what I'm telling you that when people trade derivative, right, so they can do at two main places, either on the organized exchange, right, either on the organized exchange, or they can they can do it directly with each other, right. So when they do directly with each other in a private deal, this is called OTC, over the counter or OTC trading. And there are some organized exchanges also where their trading happen. Maker, which we call dealers. So market makers, they help by regularly buying and selling contract. So why they are called market maker? Basically they buy or they sell contract on daily basis, making sure that there is always someone to trade with. And the second kind of participant is called a speculator. I mean, these are the trader who hope to make a profit by guessing which way price will go. Yes, so a speculator, basically what they do, right? They are trader who hope to make a profit by guessing which way prices will go. Because everything is standardized, it is easy and safe for the exchange to handle the buying and selling. Right. So since it is standardized, so it is easy and safe to handle the buying and selling. They use a clearing house to make sure that everyone gets paid. Yes. So settlement happened by a clearing house. Clearing house is used to make sure that everyone gets paid. Now one more thing is that to reduce the risk, trader must put down a margin. To reduce the risk, trader must put down a margin. What is a margin? Margin is like, cash deposit that act like a safety net. Margin is a cash deposit that act like a safety net in case things goes wrong, like a security deposit for a rental property. Now, everything is transparent, which means, every trade is recorded and can be seen by the exchange and regulator. So there is a little chance of secret deal. That is the meaning of transparency, which means every trade is recorded and can be seen by the exchanges and the regulator. So there is a very low chance of, secret deal. However, there is a trade-off. Why there is a trade-off? Because of this standardization, because everything is standardized, so there is a trade-off. Like there is a less room to make a special deal. There is a less room to make a special deal just for you. And there is less privacy, right? So first of all, there is a less room to make a special deal, and second thing is that there is less privacy since everything is tracked publicly. So that is why there is a trade-off. Less room to make a special deal just for you and less privacy since everything is tracked publicly. So these are the key points regarding the exchange traded product. Now the second kind of market we have is called OTC market. Now imagine making a deal just between you and the other person, agreeing on your own specific term. Maybe you want a different amount, different date, unusual condition, That is what OTC market allow. So the contract here are non-standardized. They are custom made. We can call them, custom made. This allow a lot of flexibility. You can see it allow great flexibility and is very useful for company or investor who have a special need that a standardized contract don't meet. For example, suppose a small company is there, right? And this small company want to hedge against the price of the rare metal. This small company want to hedge against the price of the rare metal that is not traded on the main exchange. So this rare metal is not traded on the main exchange, right? So they can go to a bank and design a special contract just for their situation. That is called an OTC deal. So let's summarize what we have covered so far. So we started with the derivative. I told you some points regarding the derivative. So derivative are traded on the organized exchange or in the over-the-counter market. So in terms of organized exchange, I told you, exchange traded derivative, they have a standard terms. They require margin as security. They involve dealer and speculator. They are managed by a clearinghouse for safety and transparency. So these are the feature of the exchange traded derivative. So someone is there for managing them. Market participant include market maker and speculator, right? And that they require margin as security. Contract are standardized. So these are the features of the ETC, or that is called ETF, exchange traded market. On the other hand, we have the OTC market. But the downside to exchange is less flexibility and privacy. Yes. But negative point is also there that flexibility is less and privacy is also less. Now the point is OTC market. So OTC allow custom made flexible contract that can meet a special and specific needs. Now let's talk in detail about this OTC market. So friends, think of OTC market as private deal between two parties who want to create a special kind of contract that fit exactly what they need. So these contracts are non-standardized, right? So these contracts are non-standardized. It means that they can be customized with different terms like the amount. They can be customized with different terms like the amount, like the price, or like the delivery date. They can be customized with different terms because every OTC contract is unique. So managing risk become more complicated. Since every OTC contract is unique, so managing risk is become more complex, more complicated, right? For example, imagine a business agree to exchange a certain amount of foreign currency with a bank at a price set today, but for delivery in the future. So imagine there is a business, right? And what this business agree? This business agree to exchange a certain amount of foreign currency with a bank, right? At a price which is set today, but for delivery in the future. So this is called forward foreign exchange contract. This is called forward foreign exchange contract. A common OTC derivative. This is a kind of common OTC derivative. Since these are custom deal, finding a perfect match to fully protect against price change is very tricky because this is a kind of custom deal. So finding a perfect match to fully protect against the price change is very tricky. So dealer usually manage this by balancing risk with other similar agreement. Even though OTC contract are very rare, even though OTC contract vary and are customized, they don't necessarily reduce market liquidity, right? They don't reduce the market liquidity. Means people can still buy and sell many contract. And OTC market are less regulated as compared to the organized exchange. So they are less regulated than the exchange traded market. So there is historically been less supervision, right? So regulatory supervision has increased. But however, since the financial crisis in 2008, regulators have stepped up oversight to make these markets safer, right? So they have less regulation as compared to the organized exchange. So there is historically less supervision since 2008. After the financial crisis, regulators have stepped up oversight to make these markets safer. So these are the key points regarding the OTC market. Now let's look at the participant in the derivative market. So there are three main group of people or business involved in derivative. The first one is called hedger. What is the meaning of hedger? Let's try to understand. So when I say hedger, it means these are the majority. They use derivative to protect themselves from price change that could cause loss. So basically, price change can cause loss. So they want to protect themselves from price change. For example, suppose a farmer is there. Farmer locking in a price today to sell wheat later to avoid the price drop. This is the perfect example of hedger. Second kind of person involved, participants here, is the speculator. A speculator are the trader. A speculator are the trader who try to make profit. So they are the trader who try to make profit by guessing which way price will move. Which way price will move. They guess which way price will move. They take risk hoping to earn money. And the third one is called arbitrager. So they are a smart trader who look for price difference for the same asset in different market. They exploit price difference across market, right? So basically they are the smart trader. So what does a smart trader do? They look for price difference, right, in different market. They look for price difference in different market and buy low in one market while selling high in another, making a safe profit without much risk. So these are the three main participants. I told you, hedger are the majority. They use derivative to protect themselves from price fluctuation that could cause loss. Second one, I told you, the speculator. They are the trader who try to make profit by guessing which way price will move. Third is the arbitrager, a smart trader who look for price difference for the same asset in different market and buy low in one market and sell high in the other market. Now if we look at the function of the derivative, so derivative perform important job in the financial market like price discovery. What is the meaning of price discovery? That they help figure out what people expect future price to be, giving clues to where a spot price might head. So that is called price discovery. They help figure out what people expect future price, what people expect future prices to be. So they give clue to where a spot price might head. Second function is the risk transfer. They let people who want to avoid risk pass it to the another willing to take it. Some people want to avoid risk, some people want to take risk. So those who want to avoid risk can transfer their risk to those who want to take risk. So using this derivative, right? For example, a company hedges its risk while a speculator take that risk hoping for profit. Then we have the hedging price risk. So derivative are like forwards, right? Like futures. What they do, they protect against the bad price changes, like an airline fixing fuel cost in advance. Then we have the lower transaction cost, which means trading derivative usually cost less than trading the actual asset themselves. So if you are trading in derivative, it incur low cost as compared to the actual asset themselves. And then access to the unavailable asset and market. Basically what happened, derivative allow people to invest in asset or market that they might not directly access. So enable participation in otherwise inaccessible market asset, right? So like swapping interest rate payment between company. Suppose you are interest rate swap, right? So basically what they do, they allow people to invest in asset or market that they might not directly access. And they have high leverage. With derivative, you can control big position with a smaller amount of money upfront. You have a small amount of money upfront, no worry. You can control big position. That is called high leverage. This means you can gain more if price move in your favor, but also risk losing more. Yes, if price move in your favor, you can gain more, but also there is a risk of losing more. For example, imagine a coffee producer who is worried about coffee price dropping in the next 6 months. He is worried that coffee price will drop, right, in the next 6 months. So he used an OTC forward contract. He used an OTC forward contract. They agree with a bank to sell their coffee at a fixed price in 6 months. This protects the producer from price fall, but the bank takes on the risk, hoping to profit if the coffee price rise. So friends, let's summarize the key point which we have covered in this particular slide. I told you OTC derivative are customized contract tailored to a specific need but make risk management more complex. Then I told you forward foreign exchange contract is the common example of this OTC derivative. Yes, OTC derivative, they are customized contract. They are tailored to a specific risk, but risk management is more complex. Example I given you, forward foreign exchange contract. Then I told you perfect hedger are hard to find, right? And that basically dealers offset risk by using similar contract. I told you about the name of some participant like hedger, like speculator, like arbitrator. Then I told you customization does not always lower how easily contract can be traded, right? OTC market have been less regulated but now face more oversight after the year 2008, because earlier they have been less regulated, but after the year 2008, the regulation have increased after the 2008 financial crisis. Then I told you that main participant, three participants are there: hedger, which means protect from risk, a speculator who bet on price change, an arbitrager who exploit the price difference. Then I told you the derivative help discover prices. That means expert future, they expect the future price to be this much. Second point, they help to transfer the risk. That means hedge against the price change. They help you to reduce the cost and provide market access, and finally allow high leverage. So these are the functions of the derivative. Now then in the next slide we talk about the types of derivative. So basically derivative are the financial agreement whose value come from another asset. So what are the main kinds? First of all, we have the commodity derivative. Commodity derivative means what? Their value come from the real physical goods like wheat, gold or oil. For example, a farmer can use a commodity derivative to lock in price for his grain, protecting himself if the price fall at the harvest time. That is called commodity derivative. Second kind of derivative we have is financial derivative. So these are based on things like currencies, interest rate, stock or indexes, right? So that is called financial derivative. Like imagine a business that trade with the US. Suppose there is a business that trade with the US and they want to fix the value of its rupee against the dollar for its future payment. That is called financial derivative. Third kind of derivative we have is the exchange traded derivative. So these contracts are standardized. These contracts are traded on official stock exchange. Standardized swaps are they are the agreement to exchange different financial benefit. Like what kind of financial benefit are exchanged? Like payment in different currencies or in different interest rate. So that is called swap. We will discuss in detail about this swap, like payment in different currency or different interest rate. And so they are OTC product. Then exotics. Exotics are more specialized contract with unique feature. We will discuss in detail. So now let's start with the first derivative that we have. This is called forward contract. So focusing on forward contract. So the definition. So basically this is a simple agreement between two parties to buy or sell something, right? Like they can buy or sell dollar, they can buy or sell oil, they can buy or sell gold, right? At a set price on a future date, at a specified future date, at a set as a price agreed today. So this agreement is made now, but the actual exchange happen later. So let me give you one example. Suppose today is 30th September 2021. Take the example. Suppose today is 30th September 2021 and the current USD versus INR rate is suppose 74.32 rupees per dollar, right? So this is the rate. Now suppose if you want to buy dollar 1 month from now, so you might agree to 1 month forward rate of how much? Rupees 75.12. This is what you agreed. So for 3 months, it might be 76.56 rupees. So this let you know exactly what you will pay even if actual rate changes in the future. So this is the best example to understand the forward, the concept of forward. I told you that suppose current dollar INR rate is this much. If you want to buy dollar 1 month from now, you might agree on a 1 month forward rate of 75.12. So for 3 months, it might be 76.56. So this let you know exactly what you will pay even if the actual rate changes in the future. Now the question is why to use forward? Yes, this is a very good question. Why forward? Because businesses often use this to remove the uncertainty about what they will have to pay in the foreign currency. So because if you use forward, the uncertainty will get eliminated, that what amount has to be paid in the foreign currency. For example, an importer in India who will need to pay in dollar later can lock in the rate today, avoiding surprises due to the currency fluctuation, right? So that is the benefit of this kind of forward. So you can lock in the price today to avoid any kind of surprise in the future. Now the question is how the rate is decided. So basically it usually start with the current exchange rate, that is called spot rate. It start with the spot rate and adjust for the difference in interest rate between the two currency. So you start with the spot rate and then interest rate differential between the two currency is stretched over the contract time period. That is how the rate is calculated, right? So here is an example which has been given to you. Like you can see on 30th September, the spot dollar versus INR rate they have given is 74.32. 1 month forward they have given, 3 month forward they have given, right? So basically, how do we calculate 1 month forward? Very simple. You start with the spot rate, you add interest rate differential. You add the interest rate differential. After adding, you will get the 1 month or 3 month forward. That's it, right? So let's recapitulate the key point which we have covered so far. So about the derivative. So I told you now that in the context of derivative, what I told you, that derivative can be based on commodities or the financial asset, right? And can be either traded openly on exchange or privately, they can also be traded. Next point I told you main types, which includes future, forward, option, swap, exotic. Then I told you forward contract are agreement to buy or sell at a set price on a future date. They are often used to lock in currency exchange rate, protecting business from an unpredictable cost. The agreement is made now, right? Settlement happen later, and the price factor in currency, current rate and interest differential. I given you example like Indian importer uses a forward contract to fix how many rupees they will pay for US dollar in the future. Now friends, in the next slide what we discussed, in the next slide we discussed the key feature of a forward contract. So imagine you and a friend agree today to buy or sell something like a US dollar at a specific price 6 months from now. This agreement between you and your friend is called the forward contract. Now, what are the main features? First of all, it is fully customizable, which means the contract is directly negotiated between the buyer and the seller. This means you can decide the amount, you can decide the price, right? You can decide the settlement date, right? Everything you can decide between mutually, right? For example, suppose a 6-month forward contract is there, right? To buy dollar against Indian rupees. It might be set at exchange rate of 77.12. Suppose it is set at the exchange rate of 77.12. So that is a customized deal. Next point is no money exchange now. No initial cash flow. That means no money exchange now. So when you make the agreement, no cash exchange, no cash changes hand upfront. The payment and the delivery happen only at the contract maturity. That means settlement occur only at the maturity. No initial cash flow, no money exchange now. The payment and the delivery happen only at the contract maturity, which is the agreed future date. Next point is the firm commitment. Next point is, firm commitment. Which means, both parties must follow through on the deal. Neither buyer nor seller can back out unilaterally. So there cannot be unilateral exit. That means both parties must follow through on the deal. That is called, firm commitment. Then, genuine purpose in India. So basically in India, to enter a forward contract, there should be a genuine underlying reason, like a confirmed order to import good, a letter of credit, or a documentary bill. So this prevent the misuse. So basically a genuine underlying reason should be there, right, for booking a forward contract. Then, cancellation and rebooking. So basically what happen, if the contract is backed by such a genuine underlying, you may cancel and rebook the contract later. Any profit, any loss, that is called exchange gain, can be passed on to the customer. Then we have the contract without underlying. So what does it mean? Some high volume customer who have a good trading history may book forward contract even without an immediate underlying, but this is limited. So that is the point. Now let's shift our focus to the future contract. So basically these are quite similar but have some important differences. The first difference is that they are standardized and they are extended. I told you, in the forward contract it was just OTC product, but this future contract is standardized, which means unlike forward, future are standardized based on the organized exchange, which can be NSE, that is called National Stock Exchange, or this means that contract size, contract maturity date and other condition, they are fixed by the exchange, right? Then we talked about asset type. One more thing is the obligation to buy or sell. Obligation to buy or obligation to sell. What happen, a future contract legally require parties to buy or sell the asset, like currency or commodity, at a preset price on a future date. So that is called the obligation to buy or sell. Okay, as you can see, contract to buy or sell currency. So basically the future contract legally require parties to buy or sell the asset at a preset price on a future date. Let me give you some example of the asset in the future type. So basically, future can involve currencies, future can involve stocks, future can involve commodities or financial instrument. These are the things included in the future. Currency future, I told you, these are exchange traded agreement to buy or sell foreign currency at a specific price on a certain date. Everyone holding a future contract has to settle it when it expires. Now friends, let's look at the key difference between future and forward. So forward contract are forward contract are customized deal, customizable. They are flexible, right? They are flexible. However, futures are standardized and they are fixed. Then we talked about the trading venue. In terms of trading venue, forward contract are OTC, and the future contract are exchange traded. Third point is margin or security deposit. I told you, since forward contract is OTC, so no margin is required. No margin upfront is required in the case of forward contract. However, in the case of future, initial margin is required because, daily mark to market, daily settlement happen. Then if we talk about the trading hour, in terms of trading hour, if we talk about, right? So basically, you can trade anytime. You can trade anytime. That is 24/7 OTC trading. However, in the case of, forward contract, we have what? In the case of forward contract, they are traded in exchange hour only. Now the last point is, counterparty risk. Counterparty risk. So basically, in the case of, forward contract, they are directly with known counterparty. However, in the case of future contract, exchanges act like a middleman, reducing the risk. For example, suppose you buy a dollar future contract at rupees 75.50 on NSE, National Stock Exchange. So this means you commit to buy $1,000 at this rate each when the contract expires. So let's recapitulate the key point which we have covered in this particular slide. So I told you that forward contract are private. They are customizable agreement to buy or sell an asset at a future date and price with no upfront cash exchange, and both parties must fulfill the contract. In India, forward require a genuine business reason like a firm order or documentary evidence. Future contract, I told you. So future contract are standardized, they are traded on exchange, they require margin, they involve daily settlement of profit and loss. Then future reduces counterparty risk as the exchange act like an intermediary. Example of forward I given you, 6-month dollar INR forward rate at 77.12. Example of future I gave you, buying dollar future at 75.50 rupees means buying dollar 1000 at that rate on contract expiry. Now the next point is hedging foreign exchange risk using future. Yes, let's discuss this point. How to hedge the foreign exchange risk using future. So friends, let's discuss it. So basically, let's take example of a company in India called XYZ company that expect to receive $1 million in September. They are expecting to receive $1 million in September. The big concern for the XYZ is that the value of dollar compared to the Indian rupee can change before they actually get the money. So they are exposed to the USD INR exchange rate fluctuation, right? So it means that the big concern is that the value of the dollar compared to the Indian rupee can change before they actually get the money. Suppose the dollar weaken. That means the dollar fall in value. So the XYZ will get fewer rupee. XYZ will get fewer rupee, which is not good for their business. Suppose the dollar get weak, the XYZ will get lower rupees, and this is not good for the business. So the question is how this XYZ will protect itself. So they can use, currency future. They can use what? They can use currency future to protect themselves. In August, what happened, XYZ go to the stock exchange like NSE. In August, XYZ go to the stock exchange like New York Stock Exchange, right? It's like National Stock Exchange, and sell 1000 USD future contract. They sell 1000 USD future contract. Okay, each contract is for 1000 rupees, right? $1,000, covering the full value they expect to receive. So basically in August, XYZ goes to the stock exchange and sell 1000 USD future contract. Each contract is for 1000 rupees, covering the full value they expect to receive. Now the agreed exchange rate in the future contract is 75.50 INR per dollar. With this, the company locks in the value no matter what happens. So what are the possible outcome? The possible outcome is that suppose the dollar fall to 74.50. So this, which means, USD depreciate. XYZ is safe, right? Even though the market says the dollar is worthless, their contract still let them sell at 75.50, protecting them from a loss. But if the dollar value goes up to 76.00, right? So XYZ is stuck selling at 75.50 as per their contract. So they miss out on gaining from this better rate. In other words, future contracts, the dollar value goes up to 76.00. So XYZ is stuck selling at 75.50 as per their contract. So they miss out on gaining from this better rate. In other words, future contract remove the risk. Yes, it essentially future contract, future contract essentially remove the risk, but they also limit the gain, right? As you can see clearly here, this is the limitation of the future contract. So I hope using this scenario it is clear now, right? What is how future contract work and what are the limitation. Now let's shift to the interest rate. Suppose a company plan to borrow money in the future and does not want to worry about interest rate climbing higher before then. So they want to, they plan to borrow money in the future and they are not worrying about, interest rate climbing higher before then. So FRA, forward rate agreement. So it is a simple contract that let you lock in today's agreed interest rate. That let you lock in today's agreed interest rate for a loan or deposit that will happen in the future. That way, if interest rate change, it won't affect you. So for example, they are denoted at 3 into 6 FRA. It means, you agree today on the rate for a loan or deposit that lasts from 3 months from now until 6 months from now. So see, basically what you are doing, what is the meaning of this 3 into 6 FRA? It simply means that you agree today on the rate. So you agree on the rate for what? For a loan, for a deposit. You agree for a rate for a loan or deposit, right? That lasts 3 months from now until 6 months from now. That lasts from 3 months to 6 months. Suppose I say 6 into 9 FRA. So you lock in, basically when I say 6 into 9 FRA, it means you agree today on the rate for a loan or deposit that will start from 6 months and last till 9 months. So it will for 3 months, right? That is the meaning of FRA. It is a simple contract that let you lock in today agreed interest rate for a loan or deposit that will happen in the future. As you can see in both these cases, the loan or deposit will happen in the future, right? And today you agreed the rate. That is called, FRA, forward rate agreement. Then, if we talk about the settlement, how does the settlement work? So instead of actually lending or borrowing all the money, only the difference between what is the agreed, that is the fixed rate, and what actually happened, the floating rate, is paid at the start of the loan period. So if you talk about the settlement, I told you the difference between the fixed rate and the floating rate is settled at the contract start, which means, instead of actual lending or actual borrowing all the money, you are not doing that. Only the difference between the fixed rate and the floating rate is paid at the start of the loan period. There is no need to exchange the full loan amount. No exchange of principal occur. That is the meaning of how the settlement works. I'm again repeating. Instead of actually lending or borrowing all the money, only the difference between what is agreed and what actually happened is paid at the start of the is paid at the start. There is no need to exchange the full loan amount. So this is called netting principle. Then one more thing is that two types of FRA are there: buy FRA, sell FRA. So suppose it is buy FRA. So in the case of buy FRA, you buy and forward rate agreement. In the case of buy FRA, what happened? You buy an FRA, right? You buy an FRA to protect against the interest rate going up. That means you will pay a fixed rate, and if the rate go higher, you are protected. And the second kind of FRA we have is sell FRA. What happened in the sell FRA? You sell an FRA. If you think rate will go down, you get to receive the fixed rate and pay whatever the lower market rate is. So let's recapitulate the key point which we have covered in this particular slide. I told you, company can use future contract to lock in exchange rate and protect themselves from currency risk, but may also miss on the gain if the market move in their favor. Example, I told you, you are selling dollar future guarantee at a set rate for incoming dollar, whether the rate move up or whether the rate move down. The rate is fixed. Then we talked about forward rate agreement. These are used to lock in borrowing or lending interest rate for future need, protecting from rate changes. FRA settle only the difference between the fixed rate and the actual rate. They do not involve exchanging the full principal amount. Buy FRA to protect against the rising rate. Sell FRA to benefit if the rate fall. That is the two types. Now friends, that is the part 1 lecture here. Let's end our part 1 lecture here. Let's summarize what we have covered in this particular session, because recalling is a very much important aspect of our daily discussion. So let's summarize. Just give me 5 minutes and I will help you revise all the key points. So we started with the derivative. So these are the contract whose value depend on underlying asset. They help in hedging risk. They help in speculating on price change. They can be OTC or they can be exchange traded. Common types include forward, future, option, swap. The value of a derivative has no standalone value and come entirely from the underlying asset. Example I given you, butter price is a derivative of milk price. Using Indian law, derivatives are defined as security derived from instrument like shares and loan. Then in the next slide what we discussed that early form of derivative existed even before money, using goods that did not spoil easily. Then we discussed Sumerians, right? I told you Sumerians created record keeping on clay tablet, early version of the future. Then Thales of Miletus used call option like agreement on olive oil prices. Then we talked about Antwerp. Antwerp browse. They saw forward contract emerge, focusing on contract rather than immediate trade. Japan Dojima Rice Exchange started the first real future market with rice voucher. Chicago Board of Trade in the year 1848, they expanded future trading in the US for farm product and metals. If we talk about the India's context, I told you India's began future trading in the year 1875, but government ban led to informal market until liberalization. In 1995 to 2001, India's legalized and formalized derivative trading with SEBI's approval on NSE and BSE, right? So these are the points which we have covered. Then the next slide what we discussed, let me just summarize for you. So we talked about, derivative market is very large, highly leveraged, sometimes much bigger than the value of the underlying asset. Yes, SEBI allowed index future and option trading in India starting from the year 2000, with more product like stock option and future added in the year 2001. Globally, derivative market involved trillions of dollars across future, option, foreign exchange, interest rate contract. India's derivative market include equity, foreign currency, interest rate derivative worth a very large sum. Underlying asset could include commodities, precious metal, natural resources, currency, bond, stock indexes, treasury bill, and money market product. So these are the underlying asset. In the next slide, what we discussed, I told you that derivatives are traded on an organized exchange or in the OTC market. OTC is called over the counter. Exchange traded derivatives have a standardized term. They require margin as security. They involve dealer and speculators. They are managed by a clearinghouse for safety and transparency. The downside to the exchange is less flexibility and privacy. OTC market allow custom-made flexible contract that can meet specific needs. In the next slide, what we discussed. In the next slide, we discussed, that OTC derivative are customized contract tailored to a specific need but make risk management more complex. Forward foreign exchange contract is the common example of OTC derivative. Then we discuss, perfect hedges. Perfect hedges are very hard to find, right? Dealer offset risk by using similar contract. Customization does not always lower how easily contract can be traded. Customization does not always lower how easily contract can be traded. Main participants of the OTC derivative are hedger, speculators, arbitrageurs. So hedger protect the transfer risk. Hedger protect from risk. Speculators bet on price change, and arbitrager, they exploit the price difference. Then in the next slide, we discussed about the functions of derivative. I told you that, a forward contract is a simple agreement between two parties to buy or sell something like dollar, oil or gold at a set price on a future date. The agreement is made now, but the actual exchange happened later. One example I provided you, like in the year, here you can see, one example I given you, like suppose today is September 30, 2021, right? So using that example, I explain you that derivative can be based on commodities or financial asset and can be either traded openly on exchange or privately. If it is traded privately, it is called OTC. Main types of derivative I told you, future, forward, option, swap, exotics. Forward contract I told you, these are the agreement to buy or sell at a set price on a future date. They are often used to lock in currency exchange rate, protecting business from unpredictable cost. The agreement is made now, settlement happen later, and the price factor in current rate and interest difference. Yes, the price factor in two things, current rate and the interest rate differential. Example I have given you, an Indian importer uses a forward contract to fix how many rupees they will pay for US dollar in the future. In the next slide, we talked about the key feature of the forward contract. I told you, right, that Forward contract are private, they are customized agreement to buy or sell an asset at a future date and price with no upfront cash exchange, and both party must fulfill the contract. In India, forward require a genuine business reason, like a firm order, like a documentary evidence. Then we talked about the future contract. I told you in the case of future contract, they are standardized, they are traded on exchange, they require margin, they involve daily settlement of profit and loss because future contract are standardized. Future reduces counterparty risk as the exchange acts like an intermediary. Question may be asked that is there counterparty? You know what is the meaning of counterparty risk? Basically, there is a risk that the other party whom you are doing settlement, they will not be able to pay you back. That is called counterparty risk. So such kind of counterparty risk is completely eliminated in the case of future contract. Right. Example of forward I have given you 6-month USD INR forward rate at 77.12. An example of future I have given you. Right. Two example we have already discussed. Then in the next slide what we discussed, in the next slide we discussed about the futures. Right. I told you about the future that company can use future contract to lock in exchange rate and protect themselves from the currency risk, but may also miss on the gain if the market move on their favor. See, currency risk is also there, right? So to hedge against this currency risk, the futures are being used, but they may miss out on gain if the market move in their favor. Example I given you, like selling USD future guarantee at a set rate for incoming dollar. Then we talked about the FRA. What is FRA? Forward rate agreement. So FRA, they are used to lock in borrowing or lending interest rate for future need, protecting from the rate change. FRA settle only the difference between the fixed rate and the actual rate